Good afternoon. Hope everyone can hear me. Hoping you're all having a wonderful 2024 so far. Thank you so much for joining us for our annual look at the market. I'm Shannon Corpus, financial advisor at King Wealth Planning. So today we're diving into the global economy, the market, and the opportunities and challenges that may lie ahead for 2024. Our host is Paul King, CEO of King Wealth Planning and LPL Financial, registered principal. Excuse me. Our esteemed speaker is Jordan Jackson, Vice President and Global Market Strategist for the JP Morgan Asset Management Global Insights Strategy Team. And a little background on Jordan: he's responsible for delivering market and economic commentary to clients across the country. And he's a frequent guest on Bloomberg, CNBC, and other financial news outlets. He's authored several papers on the economy and markets with a focus on public fixed income and monetary policy, and is often quoted in the financial press. In addition, Jordan is responsible for conducting research on the global economy and capital markets, as well as publications such as The Guide to the Markets and weekly blog posts. Prior to his role on Global Market Insights, he worked with the Global Consultant Strategy Group based in New York, where he was responsible for serving the investment needs of institutional asset management consultants in North America and Canada. So let's all welcome Jordan as he gives us his time today. Welcome. And before I hand the mic over to Paul and Jordan, I have some need-to-know items to cover really quickly. First, today's session is being recorded and will be available at a later date through the King Wealth Planning website. Next, we'd love to hear from you during today's presentation. Due to compliance regulations, as you know, the chat feature is disabled. If you have a question, please feel free to send your question through email to kwp@kingwealth.com. We will address questions at the end of the session. And that concludes my need-to-knows. Paul and Jordan, over to you.
Thanks, Shannon, and thanks for everyone tuning in. It's always interesting to start the year and figure out where we've been and where we're going. And JP Morgan's just been a great partner over the years and provide a lot of resources, including part of what Jordan's going to present today is this guide to the markets. It's been a remarkable set of information that's, for me, fairly easy to digest, but Jordan's a lot more familiar with it. And so we'll do a little interactive session here. You will see in the upper right, celebrating 20 years. That's not King Wealth Planning. We're 35 years plus at this point, and I think JP Morgan probably a little longer than us. So 20 years is the guide to the markets, and maybe you can speak, start with that, Jordan, is just, what the guide to the markets is all about. But, I think everyone on the call probably knows us, but, we do work with our guiding values every day, ethics, relationship, and service. And, that's something we strive for all the time. So what we're here today is really unbiased information, just really trying to present, where we've been and where we're going. And whenever you have a question on investment side, economics, today probably a lot of politics, or any particular financial planning questions, you can always get a hold of us. So with that, we've been through a lot. We had some high inflationary environment, and the end of the year turned out to be pretty nice, but at the start of the year, we were talking about not just possibly having a recession, it was really how deep and how long it would last. And yet we seem to have skirted that a bit. So with that, I'll turn it over to you, Jordan, and just let me know when you want to advance a slide, and I'll have a few questions for you along the way.
Awesome. Really appreciate the introduction, Paul and Shannon, and thank you all for taking your time to join us here this afternoon. Pretty perfect timing as well, given that Chairman Powell is still going on in terms of the first Fed FOMC meeting of 2024. But as Paul highlighted, right, I think sort of the general consensus coming into 2023 was not if a recession was going to occur, but when the recession was going to hit. And many of us had anticipated a recession materializing sometime around the second half of 2023, when in fact the exact opposite happened. You actually saw growth really begin to pick up beginning in the third quarter, and we rounded out the fourth quarter on some pretty strong footing. So fourth quarter growth came in at about 3.3% quarter over quarter, and that's actually lifted year over year growth for 2024 to 3.1%. That is much stronger than the roughly 2% trend growth rate in the US economy. And when we look at the details of the report, the strength was really broad-based. Obviously, consumers have continued to fuel overall economic activity, but we also had other supportive numbers in areas like investment spending from businesses. We also saw, I believe, given that mortgage rates have now finally come off their peaks, a bit of stabilization in the overall housing market. And then we also had a bit of a boost to overall net exports in the fourth quarter of last year. So, you know, pretty much across the board, some strong readings. And now when we look at, although it's still very early in the year, our models for first quarter growth for 2024 is right around 2%. So we continue to have some strength, some resilience. And maybe if I could just take a step back, you know, our broader outlook for 2024 can actually be summed up using the numbers 2024. So we expect 2% real GDP growth this year, 0 recessions, 2% inflation to be achieved by the fourth quarter of this year, and roughly the unemployment rate averaging 4%. So that is a succinct way to think about our base case for the broader macro backdrop for 2024. Now, moving ahead one slide, and just given that we know the lion's share of economic activity is the consumer, to a large extent, your outlook on the economy hinges on your outlook on the consumer. And the way I've been describing consumers are they're bending but not yet breaking. So where's the bend happening? Well, when you look at data like a savings rate, it certainly suggests that consumers have more or less spent down all the excess savings that they had accumulated coming out of the pandemic. When you look at the bottom right-hand side chart on this page, this flows into early delinquencies. So consumers missing interest payments. You can see auto loans, credit card loans, delinquencies have started to move higher. That's a sign that consumers are coming under a bit of pressure. And then once we get the fourth quarter data in, I'd imagine that student loan delinquency is going to pick up as well, given student loan payments started in October of last year.
Jordan, where do we see mortgages in that delinquencies?
Sure. So mortgage delinquencies have actually remained pretty low. And part of the reason is because, and to some extent highlighted on the top right-hand side chart, but many Americans took the opportunity to refinance their largest liability item at 2-3%, i.e. their mortgage at 2-3% coming out of the pandemic, either purchasing a new home or buying or refinancing their existing mortgage. And in fact, if you look at the average mortgage rate for homeowners that have a mortgage, on average, it's at about 3.7, 3.8%. That's a big spread between stepping into a new mortgage that's in the mid sixes right now. And so when you look at that top right-hand side chart, and mortgages are included in this, looking at overall debt payments as a percentage of disposable income, that household debt service ratio, consumers were shelling out a lot more money prior to the financial crisis on interest payments than they are today. And that's why I think we've effectively avoided a recession. Remember, a lot of these mortgages are 15-year, 30-year fixed mortgages. Those payments are not going to be changing. And in fact, if you rewind the clock back to 2005 and 2006, about 25% of newly issued mortgages had a variable rate feature, and many of those borrowers were subprime borrowers. That number is lower than 5% today, right? And not only that, the tightening in lending standards has forced banks to extend those mortgages to really higher quality borrowers. And so consumers are still in a pretty decent shape. They're certainly feeling the pinch of higher prices, but may not be feeling the full extent of tighter monetary policy through higher interest rates because of all this refinancing that's happening. Now, if we turn to the next slide, just to talk a little bit about why we think consumption growth will continue, it's tight labor markets. The unemployment rate's now at 3.7%. This is now the 25th, or December was the 25th consecutive month in which the unemployment rate was below 4%. You have to go back to the 1960s to experience a labor market that's been as robust for as long as it has been. Now, you would anticipate to see wage inflation actually rising, but we're seeing wage inflation gradually coming down, as evidenced by the blue line that we show here on this page. Now, there were certainly some wonky things happening with the wage inflation data in the throes of the pandemic. Remember, a lot of lower skilled or lower wage earners were let go, and so that mathematically kind of lifted that wage inflation number. But we're seeing signs that wage inflation is really stabilizing at around 4 to 4.5%. Now, with that being said, it's a great environment, because now with wage inflation at around 4 and overall inflation sort of closer to around 3%, you're seeing real positive wage gains, right? Consumers are feeling a little bit more juice coming out of their paychecks, and that's a really important dynamic and tends to be very supportive for consumption growth going forward. This is why we think that so long as labor markets remain healthy, that the overall economy is going to remain firm, and consumers will continue to spend over the next all the way through 2024.
And for those retirees in the audience, we've seen a nice jump in Social Security payments because of the COLA.
Yeah, 2023 saw about a 9% adjustment to the COLA payment, so a nice step up. On terms of retirees, while the labor market remains pretty healthy, we're seeing signs that the momentum in the labor market is gradually cooling down here. So that left-hand side chart just shows the top left-hand side, just shows the month-over-month change in job gains in the economy. And then that gray line is that 3-month moving average. And so we've gradually sort of stepped down to about 165,000 payroll gains per month. It's a much slower rate than where we were averaging in terms of job gains in 2022 and the earlier parts of 2023. But we still think this is an economy that will continue to add roughly 100 to 150,000 jobs per month, and that keeps the unemployment rate well anchored at just below 4%. On the top right-hand side chart, though, what's interesting is part of the reason why, even in a more adverse economic scenario that could play out in the economy, we think the rise in the unemployment rate is somewhat limited. And part of that is because of labor supply. The top right-hand side chart just shows labor force participation. So the light blue line is looking at participation rates for the 25 to 54-year-old cohort, which is above where we were at prior to the pandemic. So that cohort is everyone's pretty much back to work. But that 55 and older cohort, we saw a lot of early retirees as a result of the pandemic. And it's kind of hard to get off of the beach and get back into a cubicle. So I don't think we're going to see that participation rate move significantly higher over the next couple of quarters. And so this is just a challenging in terms of supply of labor. Now, we have seen immigration visas beginning to tick up. These are legal immigrants coming into work, and that's acted as a supportive dynamic for the supply side of labor. But it's not enough to fill all the early retirees. I think what ended up happening was, after a decade where the equity market was up over 400% cumulatively, and then during the pandemic, you saw home prices and therefore home equity values move higher. Many folks nearing retirement felt pretty comfortable about the nest egg that they had built up. On top of that, that increase in Social Security payments really created a nice picture where folks could take a step back from the workforce maybe earlier than anticipated. Turning to the next slide. Now, this is a somewhat of a touchy topic, but just looking at the risks associated with the fiscal finances from the federal government. And I know it's a topic that comes up in conversation and is certainly a concern. Looking at the right-hand side of the page, the top right chart just shows the deficit as a percentage of GDP. The bottom right-hand side chart, we know rising deficits feed through to higher debt. The bottom right-hand side shows the overall debt as a percentage of GDP. And the Congressional Budget Office projects that we'll reach 121% debt to GDP by 2033 over the next decade. There's a couple of issues, though, and these are more longer-term issues. I don't think this is a near-term crisis, but certainly something that the next few administrations are going to have to focus on. Just looking at the top right-hand side chart, you can see deficits are expected to run at around 5 to 7% of GDP over the next decade. But we've also broken down the interest outlays on the deficit as well as the primary deficit. And you can see that over the next decade, interest costs just to service the debt is going to take up about half of the overall deficit. Now, that's an issue because about 40% of government debt is owned by foreign investors, right? So you could paint a picture in which not only is a greater share of our deficit going towards interest payments, those interest payments are dollars that are going abroad. That tends to put downward pressure on the value of the dollar and could import some unwanted inflation in the US economy. When you look at the primary deficit and just kind of focus your attention to the shares of spending for the US budget deficit budget last year, about 60–70% is non-negotiable. It's in Medicare, Medicaid, Social Security spending. I live in DC, and when we talk about defense spending, all the conversations are how we're going to increase defense spending, not cut defense spending. And this effectively crowds out a very important share of government spending, and that's non-defense discretionary spending. These are in sectors like education, transportation, spending that hires people, pays a wage, and puts folks to work. That's where you get the economic activity. So what I'm getting at is not only are we increasing deficits potentially at the expense of the value of the dollar, we're not going to get the same economic boost that we would historically get by raising the deficit and increasing the deficit than we did historically. Not a near-term risk, but certainly a long-term risk when we think about weaker dollar, higher inflation, and potentially higher interest rates in the U.S. economy.
So Jordan, before we move on, this is my number one concern. You mentioned that the target inflation was 2% by the end of next year. And yet we have this, structural debt problem. I mean, I don't know that we returned to 2% myself, but if we did, could that be just stretched out on a longer time horizon? How do we get to 2% from where we are today so quickly?
Sure. I think that the step down from 3% to 2% inflation, the challenge, in my view, is going to have to come at the expense of economic growth. Right now there's risks, particularly geopolitical risks, emanating from the Red Sea, the Suez Canal, Panama Canal. Many goods flow through these very important routes. And this could have the impact of increasing core goods prices, increasing commodity prices again, and that, of course, potentially lifts inflation higher. So there's a lot of risks in terms of supply side risks that could reassert themselves, similar to what they did in 2021 and in 2022, and that leads to another actually move higher in inflation. And so to bring down inflation, you need the demand side to begin to weaken, right? You need potentially a weaker economy. We do anticipate a period of sub-trend growth, potentially starting to feed through in the second and third quarter of this year, and that should aid inflation to continue to trend towards 2%. I think it'll be a tough task, though, to be very honest.
All right, I think we'll watch us walk on that tightrope as we go.
Let's talk a little about the equity market. This is just looking at the fundamental backdrop, year-over-year earnings growth. Right, we buy stocks for the long run because we believe they're going to grow their earnings over the long run. And the left-hand side chart just looks at year-over-year growth in earnings per share. We've broken that down in margins, revenues, and share count. Share count's just a fancy way of saying buybacks. Those darker green bars on that left-hand side chart looks at analyst estimates for where analysts think earnings will grow over the next 2 years. And so for 2024, analysts are anticipating about 12% earnings growth. So a pretty strong year coming from earnings. Our models are calling for growth, a bit more conservative number. We're calling for about 5 to 7% earnings growth this year. The big difference is there's this expectation that margins are going to go back to increasing over the course of 2024, where we think margin growth is going to be roughly flat, right? In an environment where wage inflation is roughly sticky, we may be seeing oil prices inflecting higher, and we have started to see oil prices inflect higher. Interest costs, right? Higher interest rates are going to increase interest costs for companies. We just think margin growth is going to be roughly flat. But revenues can probably grow by about 5 to 7%. And that's where we think the bulk of earnings growth is going to come from over the course of this year. So not a bad year. just not as rosy as what some of the analysts are currently calling for. And if we turn to the next slide, obviously a big theme has been market concentration. And I think it will continue to be a big theme in the markets. But I think the equity market's going to have a good year. We're pretty optimistic. We think the equity market's going to return low double digits over the course of this year. And it's really going to be twofold. It's going to be the Magnificent Seven continuing to be magnificent, but it's also going to be broader performance from the other 498 stocks in the S&P 500. The left-hand side chart looks at the return on the top 10 names in the S&P 500 going back to the beginning of 2023. You can see that they've done very, very well, up over 60% through the beginning of the year, while the rest of the market's only up about 8% since the start of 2023. So the big guys are certainly carrying the market higher, and I think they will continue to contribute to the market grinding higher, because if we turn to the next slide, these are good businesses. These are profitable businesses. Not only that, they're investing in their companies and their business models very, very aggressively. The left-hand side chart is an interesting one. This just looks at corporate cash as a percent of assets, and we've broken this out by sector in the S&P 500. Green being growth sectors, gray being value sectors. And you can see that many of the growth sectors in the market are sitting on really, really strong cash balances. This is a completely different growth market than the late 90s and the early 2000s, where many of those companies were unprofitable. Oh, and by the way, their cash is actually yielding them something. They're getting about 4.5%, 5% returns on their cash today. When you think about the earnings growth potential as well, the right-hand side chart is interesting. What we've done here is, again, by sector, we've looked at the share of spending geared towards research and development and traditional CapEx. Those blue diamonds show the average level of spending in R&D and CapEx over the last 10 years. And you can see very clearly that growth companies are spending more on CapEx and research and development than they have over the past decade. They're spending more today, again, than they've had over the last decade. And when you look at the share of spending, an outsized share of that spending is going towards research and development. Now, what's research and development? It's generative AI. It's blockchain technology. These are productivity enhancing investments that these growth companies are making today that are going to help improve their overall earnings growth potential over the next 10 to 15 years, right? And so I think when you adjust for that long run earnings growth potential, when you look at the quality of business models that many of these growth companies, particularly the Magnificent Seven, have, we remain pretty constructive that they can continue to perform well. We've already kind of covered the inflation dynamic. I won't spend too much time here. We do think inflation is trending and headed towards 2%, though it could very well, as we've highlighted, be a bumpy ride. But just given commentary from Chairman Powell this afternoon, the Fed seems very, very committed to make sure that inflation gets back down to 2%, and they're willing to keep rates higher for longer in order to do so. On that, if you turn to the next slide, I've been very interested, or it's kind of curious to see how the market has reacted to the Fed meeting this afternoon. I mean, effectively what Chairman Powell, excuse me, effectively what Chairman Powell has come out and said, based on the committee's perspective, is that they can remain focused on their inflation goal and getting inflation down to 2%. And they're willing to keep rates higher for longer in order to do so. That said, they are biased to reducing interest rates over the course of this year. And as we show on this page, in those blue diamonds, dark blue diamonds to the far right-hand side, the committee is biased to reducing rates by about 3 times over the course of this year. And given the growth data has continued to remain strong, we think the Fed cuts rates in June, September, and December of this year. So starting to cut rates in the second half. But so far this afternoon, bond yields have come down. I think the bond market is excited about the prospects for rate cuts, but equity markets are selling off. And I think equity markets may not be happy that they've got to wait another 6 months to get the Fed to start cutting rates. It's been a bit interesting to see sort of how markets have been receiving the Fed news this week. And as we think about overall portfolios and portfolio positioning, just turning to the next slide, we still see good value in fixed income. We do think we're past sort of peak rates, right? In October of last year, you saw the US 10-year reach 5% and then come down pretty quickly. But here we're looking at a number of different bond markets. To the left of the axis is high quality investment grade fixed income sectors. To the right of this axis are extended sectors. And you can see based off of where that dark blue diamond is at relative to where yields have been at over the last decade, they're still at the upper end, right? And so we still think there's attractive rates, there's income in fixed income again. This was something we really couldn't say when the Federal Reserve had policy rates near zero. And that's really important because typically as long-term investors, if you're buying, say, a 5-year bond at a little bit over 4%, and you're going to hold it for the 5 years, you can feel pretty confident that your annualized return over that time period is going to be right around 4%, maybe a little bit higher than that. And so that starting yield in which you're buying bonds is really, really important for bond returns going forward. And being able to buy high quality fixed income right now in the high 4s, low 5%, that's an attractive buying opportunity for us. And we remain very constructive, again, not just on the equity market, but also on the bond market.
This is one of my favorite slides because I think most people think the bond market's the boring side of investing, and yet it's bigger than the stock market. It's more complex than the stock market. We have done more moves in bonds over the past few years than anything else. And like you're saying, extending maturities, taking advantage of the falling rates. 2022 was a disappointing year, but I think we're going to see that bounce back in the bond prices. Really help portfolios, especially our more retired clients. Vast majority of what they have is fixed income. So it's a really interesting piece, and I'm looking forward to seeing how we do over the next couple of years in that sector.
Yeah, Paul, it's been remarkable. I mean, I think over we're outside of the Bloomberg aggregate was negative for the first 3 quarters of 2023. We were staring down the face of potentially 3 consecutive years in which the bond market had negative returns. That was a really, really challenging backdrop. And then obviously we had a really big shift in the fourth quarter of last year. In fact, the Bloomberg Ag returned 6.8% in the fourth quarter of 2023. You have to go back to the second quarter of 1989 to get a return quarter as strong as we did in the fourth quarter of last year. So I think we took a lot of that return, certainly in the fourth quarter, and we gave a little bit of that back to start the year. But I do think it's a reflective of the environment that we'll be in over the next 2 to 3 years, where rates will gradually start to come down and bond prices will move higher. Paul, I want to be sensitive to time here. And if we could just maybe jump forward to the second to last slide in the presentation, just to be sensitive for the folks on the call. In an election year, right, obviously, as Paul mentioned, right, politics are going to be top of mind. Yep, this is the slide. Politics are going to be top of mind. But I think this is really a great slide to help remind investors to not allow how you feel politically to dictate your investment decisions, right? Political views should be displayed at the polls, not in portfolios. This chart looks at consumer confidence based off of political affiliation. So the red line shows Republican consumer confidence. The blue line shows Democratic consumer confidence. And it's really interesting because confidence levels vary widely, even though both Republicans and Democrats are experiencing the very same economy. And so it's unsurprising, under former President Obama, you saw Democratic confidence move higher, where Republican confidence remained very low. Under former President Trump, Republican confidence shot higher, while Democratic confidence actually fell. But take a look at the table on the top left-hand side of this page. The average annualized return under the Obama years was 16.3%. The annualized return under former President Trump was 16%. So if you were a Republican that stepped out of the market in 2009, if you were a Democrat that stepped out of the market in 2017, you missed out on very, very strong gains in the market. And so again, I think this is just a gentle reminder that we invest for market cycles, not presidential cycles. And even more impressively, over the last 30 years, the market has returned about 10%. And we've seen a number of different iterations of government over the last 30 years. We've also had 3 significant corrections in the market. the pandemic correction, the global financial crisis, as well as the tech bubble. Yet again, if you stayed invested and stayed the course, your portfolio grew handsomely. And so I just think this is a great slide to remind investors not to be overly politically charged in portfolios in an election year. And then the last point,
Jordan, just what it speaks to me is where people get their information, right? So we have biased sources, and if you're listening to one party in this case, tout certain statistics that are good, you're going to think things are good. And if you hear the other side's touting negative statistics, you'll think it's bad. So really, it's to come to either multiple sources or neutral sources to get your information so you make good investment decisions.
That's exactly right. And to some extent, that's exactly what we try to do with the Guide to the Markets and the Market Insights program. We try to sift through the noise, see the present with clarity, and we use that looking at a multitude of different economic indicators to help inform our overall view. And then the last point, just turning to the last slide.
We also look to international sources for information because they have a different view than the U.S. centric type of view. So definitely.
Absolutely. Just rounding things out, just with this last slide. I know it's a bit of a colorful slide. We call this our jelly bean chart. I'm more of a Skittles guy, so this will be the Skittles page for today. But each boxes represents an asset class. And we track the total returns coming from each of these different asset classes over the last 15 years on this page. Now, that lightly gray shaded asset allocation box that tracks the black line, that is a globally diversified portfolio. It's got a little bit of all these different Skittles invested in one giant multi Skittle. And this is really kind of bringing home the point of remaining diversified in portfolios. That diversified portfolio is never at the top of the page. It's also never at the bottom of the page. It is always hovering right around the middle. And that's really important for diversification. It helps to smooth out the ride for investors over time. Now, I know a year like 2022 was a tough year, right? The only thing that worked was cash and commodities. But we know that over time, again, diversification is your friend. And in fact, if you look at the two columns to the left-hand side of this page, we show the annualized return across all these different portfolios, as well as the volatility associated with those returns. You can very easily do sort of a return over risk metric to get you what we would call a Sharpe ratio in financial markets. And that diversified portfolio sports the best Sharpe ratio than any single individual asset class on this page. And so when you think about risk-adjusted returns, remaining well diversified, so that when one part of the portfolio zigs, the other part of the portfolio zags, and that's why we diversify our investment exposure. So I want to pause there and thank you all for your time. Hoping we've left enough time for some questions from the audience if possible.
Yeah, absolutely. We're moving into the Q&A segment. Let me remind participants to email questions to kwp@kingwealth.com. And while we have those coming in, we've got a couple questions for you, Jordan. The conflict in Ukraine caused a huge strike in energy costs and food prices when the war started. Is that lingering or was that just temporary?
It's still lingering. Certainly the conflict itself is still lingering. Now, supply chains have improved very significantly as economies rerouted a lot of those supply chains to avoid the area. Europe itself has redirected a lot of its, where it's getting its oil and its natural gas away from Russia and tapping into other sources. So we have seen some improvement, but we're not all the way there. And there's still risk. Actually, Europe had a negative third quarter GDP reading, a modestly positive fourth quarter reading, so just narrowly avoided a recession to round out 2023. And there is still a risk, particularly if you have a cold winter and you get greater natural gas and energy usage coming out of Europe, that we could see demand accelerating and we see another spike higher in energy costs emanating out of the region. And so while we have seen some improvement, we're not fully out of the woods just yet. And from an investment perspective, this could cause some challenges from investing internationally, at least over the very near term. That being said, I do think that there are some really interesting opportunities in the next 3 to.
Okay. In the news, they're talking about India is now the most populous country in the world.
Getting a little bit of feedback. And when Shannon's asking a little bit of
I'm getting that too. Let me and unmute. I don't know if that's any better.
Far so good.
Okay. So India is now the most populous country in the world, overtaking China. How much of the world's economy does India represent? And how should we be paying more attention to India rather than China for foreign investments now?
Great question. I don't have the actual percentage offhand, but I can tell you that over the next decade, China's population is expected to decline, while India's population is expected to increase. Not only are they looking at an increase in overall population, they're looking at overall wealth increasing, and so more and more folks moving up into the middle class. And we're actually having a lot more conversations with investors who are considering not even investing in China altogether, but using India as sort of the next sort of proxy in terms of an emerging economy. And so there's a lot of good things happening in India. Again, a growing middle class suggests that these are more and more folks, millions and millions of more people that have more discretionary income. That means they can go out and start to buy things in the consumer goods, consumer discretionary space as well. You think about how that could benefit a company like LVMH, for an example, European luxury goods, right? So, also when you look at India has actually performed pretty well from a stock market perspective over the course of 2023. Part of the reason is because India is actually not as sensitive to the broader manufacturing cycle as you'd see in areas like Southeast Asia. So India sort of weathered this slowdown in overall manufacturing activity over the course of 2023 and continued to perform particularly well. And so we see a lot of sort of structural evidence that would suggest that India is becoming a really interesting place to invest in. And our portfolio managers are growing more and more excited about the opportunity set coming out of India.
Yeah, I always thought for a long time it was sort of a misnomer to call China an emerging market, as large and dominating as they are, and now India. So, any other questions, Shannon?
Yeah, investors want to know when they can expect interest rates to decline and what are the best types of bonds to invest in prior to that so they're best positioned to take advantage of that.
Sure. Well, it's fascinating. We've already started to see interest rates decline a little bit just today. We were above 4%. Now it looks like we're back below 4% on the U.S. 10-year. But as I mentioned, we're still seeing good value. And so for investors who want to capture that, you're going to want to start and we do think high fixed income where you want to be. It's going to perform well. In that, things like 5-year U.S. Treasury bonds, investment grade, high quality operations like Apple, those companies that issue, they're additional securitized, right? Securities, assets have high duration as well, and so all these components together in a well-diversified, high-quality fixed portfolio, we think are going to be, generate really attractive returns, not just total returns, but also income over the next five years or so. And so we're really excited about the bond market and the various playgrounds that we can sort of play in when we look at the broader landscape. Remember, the Fed was at 0 rates for much of the last decade. And they've tightened policy very aggressive and lifted interest rates much higher. And so there's now a lot more attractive value in the bond market today than where we've been at over the last 15 years.
So the sound quality wasn't great for whoever's question that was, but I think we'll end it here. We've gone on quite a while. So I do have some strong viewpoints on that question, not just in the bond market, but other fixed income products that are out there, and take advantage of it before rates do go down. So give me a call. I want to thank Jordan. You're just a wealth of information, and I know we could go on for several hours. Love to talk to you more. So thank you for that. Thank you to JP Morgan for all you do. And we will, we'll see if we schedule a mid-year. It's going to be an interesting year in terms of the election and all the processes. So I do like to do a mid-year update if we can. Thank you all for attending, and we'll talk to you soon.
Thanks so much. Take care. Thanks, Jordan.
Thanks, everyone. Really appreciate it.